Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Now, there has been a little bit of pressure in the equity markets of late. You've seen corrections, particularly at the broader end of the spectrum, and so therefore, it is important to talk about what your strategy should be. We've looked at the flows into small cap as well as mid cap funds over the last 12 months, and particularly in the small cap space, you've seen inflows of over 40,000 crore rupees over the last 12 months. And anecdotal evidence suggests that there are investors that hold multiple schemes in the small cap category. This is therefore a time for you to consider reviewing your strategy. To that end, let me introduce my first guest today. We've got Suresh Soni, who's the Chief Executive Officer of Baroda BNP Paribas AMC. Thank you so much, Suresh, for taking the time. Pleasure speaking with you as always. And I think the most topical conversation has to do with how small caps are behaving, at least for now. I think to a large extent, both representatives of your organization as well as representatives of the mutual fund industry have been talking about the possibility that valuations at the broader end of the spectrum might just be a little bit stretched, and they have been advocating caution. But be that as it may, as things stand today, how, according to you, should investors deal with what they're facing right now?
Sure. So first of all, small cap and mid caps offer great wealth creation opportunities over long term. And inherently, the growth rate of these companies tend to be slightly faster than the large cap companies. So anybody who has got a long-term perspective, let's say 5 year and beyond, there's nothing to worry. In fact, investors should consider investing into these products, these stocks, also from a longer-term perspective. With a higher growth, these stocks also come with a slightly higher volatility, and that's what once in a while we witness. But on a broad brush, it is very difficult to just portray the entire small cap segment as a monolithic or a single entity. This represents a very large, diverse group of companies, and as SEBI has rightly pointed out, and as I think most of us realize, there are certain pockets where there is fraud, and investors will do well to stay away from those pockets. But it does not necessarily mean that small cap or mid cap investing is bad, or it is something that one should completely avoid. It is that one has to have right time horizon as well as the right process. Second thing, what one has seen in the recent time is there has been a lot of low quality stocks that have risen, and it is some of those areas that one has to be cautious of, and not the entire market.
Now, it's interesting because, and I would have loved to speak to your fund manager. Understandably, he's in the midst of things right now, and you can't expect him to leave his desk, especially today. But I'm trying to understand also from your perspective. You launched your small cap fund in October of 2023. And I would think that it was a brave decision, especially given the way that the markets have performed over the last couple of years, and the broader end at that, right? Particularly in 2023. So what about the internal conversations that you guys have had in terms of getting inflows, how you allocating, what kind of messaging has gone out?
Sure. So first of all, when we launch products, we take a longer term perspective on the product. Right. So we are not looking at the next quarter or the next 3 months, 6 months kind of performance or the market. Our product launches are essentially a combination of our readiness in terms of managing them, our own conviction into the areas, as well as are we able to find good investment opportunities. For us, that's not been a challenge at all. I think our fund managers have done an incredible job of deploying this capital in an efficient manner. The fund has done fairly well since the time of its launch, and we do not have any challenges in terms of either deploying capital or getting worried about the stocks that we hold.
Point. Having said that, in terms of allocation going forward, there are understandably a lot of investors that have poured money into small caps in particular. I was looking at the data as of February. If you look at 12 months, 40,000 plus crore has flowed into small caps. And of course, it's not uniform. They have flowed into a few schemes in particular. But having said that, if you are over allocated, what do you do in that situation? If you've got, say, 2 or 3 small cap funds, which I think is par for the course, a lot of people have those, how do you manage now?
Sure. So again, I think in portfolios, it is important to have balance. And investors have to recognize that if they are overexposed to this particular area and over a period of time, this is delivered significantly high returns for them, they want to rebalance it into larger cap and or balance advantage products. I think those could be indeed the areas that they should contemplate. However, if you have a 5 year kind of a time horizon and you are not overall allocated, there's no problem. You should continue staying invested and even consider over a period of time allocating money on a systematic investment plan basis because this is an area which has created wealth over a long period of time.
But Suresh, why balanced advantage in this situation? Because it's something that has both equity and debt, and the dynamic allocation between the two. But one doesn't replace the other. One takes exposure to a small cap or a mid cap because one looks at a 5 year, 7 year, 10 year horizon and says this is the place to be. So how does balanced advantage fit into a portfolio?
Now, so balance advantages have a slightly different role. So let's be clear. I think from a balance advantage is not a pure equity product. So I think from a market cap perspective, small and large cap or mid cap, those are the market cap dimensions. But balance advantage are products which allocate money into equity and fixed income on a dynamic basis. And these products, I think the beauty of these products are essentially in that they give automatic asset allocation to investors depending upon the market conditions. And they become particularly relevant when the market valuations are not necessarily cheap. So, when markets are typically very cheap or the valuations are very low, you want to be allocated largely into equities. And then when the markets are expensive, you want to probably reduce your equity allocation. Now, this is what most investors want to do, but this is difficult to practice. So,
So
what balance advantage funds do is they automatically do this for investors in the product, and therefore investors can kind of stay away from having to make allocation calls on a day-to-day basis,
yeah.
but let the fund manager do it for them.
Okay, so that's fair. But Suresh, from the perspective of benchmarking it, and from the perspective of expecting or setting an expectation of what returns you would expect, this is not something that you would compare to a pure equity fund, right? So how do you set your expectations as an investor?
Sure. So you're very right. This is not a pure equity product. In fact, what we have seen over a period of time is that balance advantage funds as a category typically end up having between 50 to 55% average allocation to equity over a period of time. Yet, what is interesting to see is that these funds generally manage to deliver over 80% participation to the equity market. In fact, if I look at our own fund, we have been able to deliver almost to 90% plus of the equity market returns. And essentially, you manage to do it by actively managing allocation so that your upside participation in a rising market is a little higher. And at the same time, when the markets are choppy or when they are negative and the forward expectations are not particularly good on the market, then you tone down on the equity exposure. So what we tend to do is what behaviorally investors may not necessarily be able to do. So we essentially run these funds on a model which looks at the valuations of the market and allocates money between equity and fixed income on a continued basis so that investors can get upside of the equity market, but at the same time, on a downside, they are protected and they don't fall as much as the equity market falls.
Okay, that's a fair point, and that's a topical point to make, particularly given today's move and the move over the last few days. In the event that you are, in fact, over allocated and your portfolio is skewed, then this is perhaps the time to look at a review. Thank you so much, Suresh, for joining and for giving us that perspective and for speaking to us on NDTV Profit.
Thank you.
Viewers, now this isn't the end of the conversation. In fact, we're going to talk about how you should manage strategy, and particularly, I know anecdotal evidence, conversations that I've had over the last few weeks and months indicate that a lot of people hold a number of small cap funds and sometimes going into 3 and 4. Now is the time to look at that and think about whether or not you need to review that strategy. So we're going to talk about that, and also if you look at balanced advantage to help you bridge that gap in your portfolio or correct that skew in your portfolio? We'll talk about that after this very quick break. Welcome back. You're watching the Mutual Fund Show, and we're having a conversation about what your strategy should be given the recent drop that you're seeing in the small cap space in the broader markets as well. We're also talking about how balanced advantage funds fit into your portfolio, perhaps in that same conversation. But I'm joined by Nisreen Mamaji, founder of MoneyWorks Financial Services, and Suresh Sadagopan, Managing Director and Principal Officer at Ladder 7 Wealth Planners. Thank you so much, the both of you, for taking the time. I will start with you, Nisreen. We're seeing sharp cuts, but this was par for the course, because I think there are a few people that have been screaming from the rooftops over the last couple of months in particular that there perhaps is a little bit of froth building up in the broader end of the spectrum. How do investors react and move from this point?
So yeah, there is a lot of discussion happening about the small and the mid cap rally at this point of time and the correction. But if you are a long-term investor, which most of the investors that I deal with are, because we've been doing comprehensive financial planning for them for a large number of years. So the asset allocation towards mid and small cap, from the very beginning, we have always maintained that it shouldn't cross about 20 to 30% of the portfolio. Say 30 to 40% in large and flexi, and some amount, in balance advantage funds and equity savings funds and in emergency funds. So if the asset allocation is done in that way, obviously at this point of time, there will be a certain, the small and mid caps obviously will have a larger proportion in the asset allocation. But if you are a long-term investor, we do not suggest, profit booking or just selling because of there is a panic in the market, but just staying invested, because if you book the profits and you have to pay the requisite taxes, then you sit on cash and you wait for the right time to enter into the market. It sometimes theoretically sounds perfect, but doesn't actually work like that. So it's for the longer term investors who have a certain goal in mind, it's better to just stay invested and let the asset allocation and the correction happen by the mutual fund managers who will be doing taking the necessary steps in the multi-cap and the flexi-cap funds, so to speak. But so, I do not feel that we should react in a panic way at this point.
Point taken. So, but that is, I would think, Nisreen, for people that have followed a pragmatic approach and an asset allocation approach. Now, I was mentioning earlier on in the program that anecdotal evidence, conversations that I've had suggest that that may not be the case for a large number of investors. People have been aggressively sold small caps, and therefore they have bought it with the prospects of better returns. So Suresh, if there is a skew in somebody's portfolio, do they then book some profits? Because one would assume that the rally that has taken small caps up by as much as 60% over the last 12 years, notwithstanding the correction, you would have a significant skew.
Yeah, so I think I completely agree with you, Alex, in the sense that a lot of people are only looking at the returns and they are gravitating towards those schemes which are giving that return. So in this particular case, mid and small cap categories have fired up quite well, and a lot of money has flown into that to warrant SEBI to talk about the accumulating froth in this particular sector. So it is fairly evident that retail investors have been putting a lot of money into mid and small cap, and I have no reason to believe that it is part of the asset allocation strategy. Probably it is not part of that at all. So if that is truly really the case, then they should consider reallocating to other portions of the equity segments like large cap or maybe probably a flexi cap category. And any other category which includes balance advantage fund as a category. So I really feel that the froth has been building up for some time, which SEBI has correctly flagged now. Whether this is the right time to, pull out the money is a question mark. But if the asset allocation strategy is currently skewed, yeah, they can consider rebalancing and putting it in the appropriate bucket. So that's what I would say.
So, okay, fair point. Nisreen, from the comment that you made about asset allocation, you didn't mention fixed income, but you mentioned balanced advantage or hybrid that is perhaps solving that role. Is that because of the taxation aspect? And also, what does someone bear in mind right now? Do you make that shift into balanced advantage?
Okay, so the emergency funds or the funds that you need for the 1 to 3 year bucket, you have an option in the arbitrage segment, which will give you equity taxation as well. So instead of, say, a money market fund or a low duration or an ultra short fund, which are all the fixed income category, you could be looking at arbitrage for the 1 to 6 to 9 months category of investment, where you just want to park your money and you're not really sure what you want to do to go ahead. Or also your emergency funding, which, anyway, you need about 6 months of expenses in an emergency fund. So that is a segment that arbitrage will follow, into that. If you're looking at a 1 to 3 year segment, then balance advantage category would include some amount of equity, some amount of arbitrage, as well as bonds. So that would be really a very beautiful product to invest in, as long as the product that you invest in, particularly the fund is not already 60 to 70% in, long equity. So one needs to check the asset allocation before you take that step, because remember, this is shorter term money and you don't want to go into a hybrid kind of a situation where if there is an 80-20 kind of a ratio, 80% in equity or 20% in fixed income.
So from that perspective, that's an important point. Suresh, coming to you on this one, and this is effectively the last question, which is that in this hybrid category and also in the balanced advantage category, there are various ways in which fund managers approach this. So how do you choose the right one for you?
So if you look at the broad approach as far as the fund managers are concerned, they are really looking at the basic strategy of buying low and selling high. So this is typically what the retail investors don't end up doing because of various emotional biases that they are prone to. So essentially the strategy which most of these funds are adopting is either a price to book value strategy or a price to equity strategy or a combination of these two things. And using these two things, they look at which are the sectors, which are the companies, which categories, which styles, which will work well within those buckets is what they look at. So whether you look at some of the best performing funds like Balanced Advantage Fund or ICICI Balance Fund and things like that, I would say broadly they are adopting the same approach. Somebody may be only book value, price to book value. Somebody may be price to book value, price to equity, and some of them are also talking about fundamentals of business management, valuations, and things like that.
Sure.
But very broadly, I would say price to earnings, price to book value, to pick up, to allocate properly in equity when the valuations are low, and when the valuations are high, bringing down the equity allocation. So that's broadly the strategy.
Fair point. All right, Nisreen as well as Suresh, thank you so much for joining in and for giving us that perspective. Important day to be talking about this. That brings us to the end of this particular edition of the Mutual Fund Show. If you've got specific questions for us, you can send them to us on the number on your screen. There's more lined up over the course of the day, so do stay tuned. This is NDTV Profit.